today, what are we seeing? We're seeing on one hand, there is more pressure on the top line, like you can't deny it, but that pressure means that the growth is down on average, we see across our portfolio is down 20%. So when you're growing 100%, down 20%, you're still growing 80%, which is good. And the other thing that is very different is that companies have raised a lot of cash in the past 2 to 3 years. So they enter this crisis with a big war chest. So to give you an example, there are 360 cloud unicorns that have been minted in the past 3 years. This company have raised $125 billion. So on average, that's $350 million per company. So they have this big war chest now, and they just need to spend it and invest it very wisely. And our analysis is that actually most of them won't have to do a down round. Now, that said, there's a lot more focus on efficiency, and what we do with our portfolio is focus trying to focus them on that efficiency, because you can't afford to burn as much capital as you were last year when capital was free. So you need to adjust your spend to basically the cost of your capital, which has gone up dramatically.
That does put it in context, because in some sectors, as we've been having the same discussion, it feels as though there may be a clean-up, that some companies won't survive, so there'll be a ton of M&A. But you're saying in your sector, in cloud, we're not going to see a lot of M&A at this point, based on forced action.
Well, I think M&A is a different story. I think you have to look at public and and private. I think on the public side, given where the valuation are, we're actually seeing a very healthy pace of M&A. I think we're on track for large software M&A to be at $100 billion this year, and 60% of that is driven by take private. And we estimate that there is around $750 billion of cash sitting on the balance sheet of either the strategic tech buyer who can buy a software company, or the private equity fund who can do this take private. So we expect that trend to continue. What's
the motivation for a take private at this point in the cycle?
Well, I mean, I think I'm not a public investor, but what we're seeing right now is that all the underlying trends that are pushing the growth of this cloud company are still there, and valuations are now below average. And given the kind of all the focus on growth, there's been less focus on profitability. For this private equity buyer, they can say, well, the underlying trends are strong. Companies are not very efficient right now, so we can make them more efficient. And actually, the valuations are below the average. So that's kind of how I would think about it if I were in their shoes.
Just finally, can I ask you about the IPO window? When does it return? When do all these companies that have been in the pipeline suddenly return to the public markets?
Well, I think right now there's just too much volatility in the market, so the IPO window is closed. But as I said, I think for our companies, it's on the private side, they have a lot of cash. They're going to continue to grow. The trends are going to continue to push them. And whenever volatility goes down and the IPO window reopens, I think we're going to see the next generation of champion, especially emerging from Europe, because the ecosystem there has been very strong in the past few years.